First, let me say I'm very glad to be back in Uppsala again. My wife and I had a wonderful time here when I gave the Lindahl lectures, and we're both happy to be back here again. For a student audience, I think it's interesting and important for future careers to convey how people settled on research questions, how they came to choose what to work on, and how to approach it. And that's how Dale started. And I'm going to do some of the same. Excuse me. I just finished a chapter for a book edited by Michael Zenberg on how I pick different research questions. Got a congratulatory email from Zenberg over the Nobel Prize, along with a statement that he was so relieved that I was ahead of the deadline on finishing the chapter, or it might not have happened before the book comes out. I've been very busy since October 11th because, unlike Dale and Chris, I stopped working on search theory 15 years ago. So I've had to have a crash course on what's been happening ever since. And so my focus here is going to be very much the earlier approach to the literature, and also focusing on the things I did that there's a lot of overlap in what we did, but I'll focus particularly on the things I did that look somewhat different. And part of the interest here, you'll hear from Chris, and I've cheated, I heard him back in Stockholm. You'll hear from Chris, as you heard from Dale, that they were both focused on the labor market, on unemployment, and how to think about these issues is what led them to this line of modeling. I came at it rather differently. I, as an undergraduate, took a course from Gerard Debreu just after Theory of Value was published. He was an outstanding teacher. Later, he was my colleague at Berkeley. And I got deeply grounded in the workings of what we call the Arrow-Debreu model, the general equilibrium theory. And when you're thoroughly embedded in something like that, you're as aware of the shortcomings as you are of the successes of what it does. And from early in my career, I was interested in how to change the model, how to do away with the extraordinary ability assumed for the Walrasian auctioneer, the completeness of markets, the fact that in that theory, coordination of current trades and coordination of future trades are identical, and that clearly isn't the case. So I've thought from early on in my career, I can actually date, it was August 1965 when I was working away on how to break out of that model, and I took a very simple approach. I just assumed the set of markets was incomplete. I didn't attempt to derive it within the model. There's always a tension among economists between what you assume that isn't, quote, fundamental, preferences, technology, trade technology, and what you simply assume is a restriction on what's going on. And there are values in both ways of going. Obviously, if you start with a non-basic assumption, you're closer to where you want to get. The analysis is easier. You can focus on the parts that you want. On the other hand, there is the risk that the underlying reasons might make what you do with a model unattractive. Keep in mind, a model, by definition, is an incomplete picture of reality. That's what we mean by a model. And so the best you can hope for is a model might be insightful, useful for some particular question. At the same time, it's useless and possibly worse than useless, misleading about other questions. So you don't ask, is a model good or bad? You ask, is a model good for this question or that question? So I just assumed a limited set of markets. I knew I was using basically one period model, and that was special, and a lot of things wouldn't carry over. I just had no idea how to push beyond a single period, but it was a start. It pressed into formulating how to think about normative issues in a model like that, and the approach I took there of constrained Pareto optimality rather than full Pareto optimality is indeed the way search theory evaluates things. And the idea is, if you think of the centrally planned alternative, you want to put restrictions on the central planning that capture the same way the restrictions on market opportunities are, for presumably the same underlying reasons. And you also want to identify where things might be different, and the government may have an advantage or a disadvantage. The disadvantage work of late comes about from the difficulty of governments in making commitments, which markets, having the government to enforce contracts, has less difficulty doing. On the other hand, the government has the ability to do things like collect taxes, and so impact large numbers of people with very low administrative costs compared to what a firm might do. So that goes either way. And what's interesting is the later work started in the thesis of Oliver Hart and then extended to a full-blown theorem years later by Giannakopoulos and Polymercharkis, is it stood the fundamental welfare theorem in the Arrow-Debreu model on its head. As you all know, with the standard assumptions, no externalities, etc., a competitive equilibrium is Pareto optimal with a complete set of markets. And in contrast, generically, an incomplete market equilibrium is always not constrained Pareto optimal. The government can do better generically, but not absolutely always. So my starting place was thinking about that, and as I looked at the literature in the late 60s, there were a lot of people focused on the fact that Arrow-Debreu theory is a theory about the allocation outcome. It is not a theory about how the economy actually organizes finding that allocation. And so people worked that tâtonnement was the approach taken earlier, going back to Valras, and people worked on exploring the mathematics of tâtonnement. The most famous result was due to Herb Scarf, who produced an example of an economy so that tâtonnement would not work. Tâtonnement is where there are hypothetical prices, people respond, if these are the real prices, here are our demands and supply, and then using an adaptive algorithm, raising prices where there's excess demand, lowering them where there's excess supply, or maybe the other way around. Everything is whenever I teach, is modulo sign error. And that's good education. If you can get the sign right, you probably know what I'm saying better than I do. So he had proved that, but there was still a lot of focus then on how could we modify this algorithm to make it work. And it struck me as one of these moments when you think about what you want to do, that they were asking the wrong question. The question they were asking was, can I design an algorithm that will convert to competitive equilibrium? And the question I chose to ask was, if you take a plausible adjustment process in real time in the economy so that things are actually happening, what does it converge to? Does it converge to the competitive equilibrium, or does it converge to something else? And the plausible model I chose was a search model, and as Dale said, visiting stores one at a time as the only way of getting prices. I was out of the country on my sabbatical, so 15 months away. No internet back in the late 60s, I'm sure you're aware. So communication didn't exist. I didn't know about the Phelps volume until I came back. But it's no surprise in science, not just economics, when an idea is in the air and there are many people discovering independently and in parallel a lot of the same ideas. So I produced a model that demonstrated, it wasn't a realistic model of pricing, but it demonstrated that you could get a very different answer, about as different as you could, and then it was such a attractive question and lent itself to a lot of analyses that a bunch of people jumped in and started exploring what it took to have a single price or a distribution of prices. If you had a distribution of prices, where did that distribution lie? It was good questions, and there was really then a genuine community of search theorists. Dale has done such a lovely job of explaining the finding that I'll skip over it and have some more time for something else. I did, as Dale pointed out, a number of models relating to the labor market, or I thought of the work with Eric Maskin as something focused on a summer rental, because it was a process of contracting and recontracting leading to a date at which everything would actually be executed. So labor market doesn't work for that, so I thought of summer rental. That seemed to be something that had that kind of cutoff. And then I pushed from that into labor markets in ways that were strikingly parallel to what Dale was doing at the same time. We were both aware of each other working on it, but we weren't in very close communication. I assume internet probably would have changed that as well. And I refer back to that as parallel play. We were, as is used to discuss what little kids do in a kindergarten, when they don't really interact, but they're kind of side by side. And we were both having a very good time and a very fruitful time. At the same time, I was concerned about the macro implications in a way that focusing on the labor market was not adequate for. As Dale said in describing the Great Recession didn't happen inside the labor market. It happened because things outside the labor market impacted the labor market, and then consistent with the theoretical modeling, the labor market reacted to the change in demand and the change in supply, and those were related to housing prices and the capital market. And then whatever actions governments and central banks and treasuries took in response to that. So I was interested back then in the aggregate demand question per se, and it's very hard to work where you have frictions in the labor market and also frictions in the output market. If you think about it for a moment, most of production happens without knowing who you're going to sell the product to. You manufacture something, it goes to the wholesaler, it goes to the retailer, it shows up in the store, it gets bought or it doesn't get bought, it shows up in the sales, it shows up in now online in the stuff that just didn't get sold anywhere else. So there is the same kind of coordination issue, but with a very different structure in the output market. Or you could think of services which do get contracted for, but often involve considerable capital investment to set up for that. You have a barber shop and people come to have their hair cut, and there's capital investment there in anticipation of customers coming. Or you open a restaurant and you hope people like the food and come, and of course there's a huge turnover of entry and exit in such small businesses, restaurants, prime example. So there are lots of coordination issues there. And rather than trying to tackle coordination simultaneously in the labor market and the capital market, the model I built wiped out any concerns in the labor market by simply assuming that the only way you could produce was self-employment. There was no labor market. You couldn't hire somebody else to help you with work. You had to do the work yourself. Consistent with the kind of modeling done for the labor market, there was the stochastic arrival of the opportunity to invest by doing the work yourself. And then there was the delay process in sales. I didn't bother trying to capture the delay process in production because that would be technologically driven, and I was interested in the endogenous delay process that comes if you assume, rather than you sell this year's fashions and if you don't succeed there's a huge drop in price, I was interested more in something where it was the length of time to a sale rather than the price that was an issue. And part of that, again, was to limit the complexity in the demand side. So the model was set up so that if you produced a standard item, you couldn't consume it yourself, you had to trade it, which again reflects the fact that by and large, while we do home production, by and large it's what we buy in the market, that's the bulk of consumption. And you would look for somebody else who had one of the same products to sell. You would trade them since they're identical, your positions are identical. The trade would be one for one. There would be no sticky price, no price that didn't clear that pairwise trade. And the issue was, if you took out from the model all the reasons in Keynesian analysis that you've got problems, could you still have what looked like Keynesian aggregate demand problems? And the answer is yes. Provided there's increasing returns, you can have multiple equilibria. And now multiple equilibria is a funny concept. It says the model is incomplete. There's something that we're not modeling, in particular expectation formation, that will determine what happens because something happens. It's not like electrons, which are a probability distribution in space in the small in terms of quantum physics. It's something happens in the economy, and even within rational expectations, then you can have multiple equilibria. Then you need a theory of what gets focused on in the equilibrium. And of course, in practice, there are always diverse opinions about what's going to happen. There isn't that level of coordination. So the focus I had was on constructing a model with that property. As Dale said, increasing returns are a big issue. Empirically, as my work with Olivier Blanchard and the extensive work by Chris and co-authors, both estimating and surveying, makes it clear that for the labor market as a whole, constant returns to scale is, if not exactly accurate, very close to accurate. But I was thinking about not just the labor market, but the whole process of going from hiring, capital investment, production, wholesale, retail, stores, sales, and thinking of that process without any formal modeling. It seemed to me increasing returns to scale was plausible because when you have excess capacity and you don't have smooth production functions, you then will have something that should resemble increasing returns for the process as a whole. It's very hard to proceed on that line empirically because we have data on workers, we have data on jobs. We don't have the same kind of data on, in the small, you buy this, you don't buy that, that kind of element. It's not there. So there hasn't been the back and forth between theory and empirics in this overall aggregate demand perspective that there has been in employment. In fact, there's hardly been anything whatsoever on either the theory or the empirical side, except, of course, that the neo-Keynesian, which doesn't fully incorporate the kind of search frictions, does indeed recognize some of these issues. So that's all I want to say about the theory. I'm not going to say anything about the theoretical aspects of the model. Dale told you a bit of that, and Chris will tell you some more. So there's the outline of the talk I gave in Stockholm. It has nothing to do with what I'm doing here. But what I want to do is move into the discussion of the beverage curve, where Dale ended. And what I want to do is focus on data issues. There is this slightly amusing misfit. The matching function, when you're doing theoretical work, as Dale said, is the rate of meetings of potential employer-employee, which might lead to a hire. And then they have to make a decision. Given heterogeneity, is it good to start production here or not? And in empirical work, since we don't have data on meetings, the matching function is the hiring rate. The meeting function times the fraction that successfully leads to hires. Same term, means something different. Context makes it very clear which is which, so I don't think we need to either change one of them or both of them to something else. So I want to start for background of where I'm going with the Beveridge curve just by reminding you of how big the flows were. You saw one picture of that from Dale, and here are some others. This is monthly worker flows in the US over the last 20 years. So of the workers who are unemployed in 1 month, that's the U, no surprise there, 37% are employed in the following month. Of the workers who are unemployed in a month, nearly 33% are out of the labor force in the following month. Why I? I for inactive, just to have two-letter acronyms. Of the people out of the labor force, and there are far more of them than there are of the unemployed, there are flows directly into employment. So it's not, as in the simple theory, the unemployed who get hired, or as Dale extended, there are also people who go directly from one job to another job, but there are people who are not in the labor force, not just new entrants. People lose a job, quit a job, not look for a job for a while, start looking for a job again. That would be a flow from inactive to unemployed, be out of the labor force, and land a job. That would be the IE flow. And interestingly enough, among the employed, there are people flowing into unemployment, and there are people flowing out of the labor force directly. And it's not just retirees. It's people taking off for a while, people waiting for the job market to change because they don't want to move. The local market is no good. It's a little bit like in house search. When you go to buy a house, the first thing you do is you inspect the stock of existing houses. And if you've decided none of them are a match, you wait. You wait and look at the flow of new houses that come on the market. And so there's been objections, Jim Tobin, for example, that concept of search was the wrong concept, that a great deal of unemployment is wait unemployment, not search unemployment. And I think that's right. You can capture that in a slightly richer than the most basic model by having a search intensity variable. And so you're searching, but it's such a low level, you can't tell it apart from waiting. The US is an outlier on the size of the flows. This is just in and out of unemployment, no separate distinction between employment and out of the labor force. And then Scandinavia and the other English-speaking countries are midway, and then you see down there with Italy, labor markets that have very little flows. The macroeconomists have paid a lot of attention to this, had basically the view that high flows contributes a great deal to efficiency, and therefore trying to ease up firing rules, because when firing rules are tough, firms are reluctant to hire because you're locking yourself in much more than otherwise. It's a much more important investment. So the flows, though, this is not a US-only topic. The flows, as you can see, are quite large in many countries. Next, I want to do what Dale did as well, talk about it from the perspective of the employers. And so job creation and job destruction, you interview employers and you say, now compared to a month earlier, or in this data case, a quarter earlier, do you have more workers, fewer workers, the same number of workers? If you have more workers, you've created jobs. If you have fewer workers, you've destroyed jobs. So that's the vocabulary. And the rates here are relative to employment. So in expanding firms, they've added 7.5% of the stock of employees they had before in the typical quarter. Again, big flows. And the layoffs, the quits, the shrinkage, quits that aren't replaced, that's job destruction. And it's almost the same size. The impact on job availability is the small difference between two large flows. And if you look at the whole process of hiring and separating, that's job creation, but also replacing workers who leave. It's about twice as big as job creation. And if you look at separations, that's about twice as big as job destruction, because as you see, averaged over this 2-decade period, quits are approximately the same size as layoffs, but the two of them behave in opposite ways in the course of the business cycle. So here's the same data that Dale showed you without the dates on it, and my focus is on the extreme high unemployment rise the most recent year, with the beverage curve moving basically vertically. Vacancies have been increasing. Unemployment has been stuck in the US, not moving. And here's the kind of quote that Dale referred to, somebody thinking old-fashioned model, not new flow model. The somebody is Narayana Kocherlakota, an outstanding theorist, recently appointed president of the Federal Reserve Bank of Minneapolis, and coming out of the macro perspective in Minnesota, which those of us in Cambridge are by and large not big fans of. And here he is saying, firms have jobs but can't find workers. Workers want to work but can't find jobs. And as Dale showed you, about 4 million hires in a month going on. So the vacancies are being filled and filled very rapidly. The workers are finding jobs and finding them very rapidly. We're stuck for reasons that have nothing to do or little to do with this. Perhaps there's less efficiency going on because there is some mismatch issue, and that's what I want to focus on. Here's the same picture in terms of hires relative to vacancies, and you can see that hires relative to vacancies go shooting up in the recession because there are a lot of unemployed. Unemployed show up. You get fill your vacancies very quickly. And what's been happening in that last year is that this has been going down. The vacancies, hires relative to vacancies, has been declining even though unemployment has remained high. So that is a drop in the matching function. And if you think in aggregate terms, where the representative agent and a representative job, the natural thing to say is mismatch. So what's going on here is these things are filling more slowly because you can't find the right kind of workers. And what I want to do is spend a little time disaggregating this and explaining that it's very hard to draw inferences about this, in part because we're out in a range of unemployment and vacancies we have not seen with any of the data that we have, and really haven't seen since the Great Depression, with analyses done with other data. So the first point I made already is hiring doesn't happen just from the unemployed, it happens also from people out of the labor force. If there's something that changes the mix of unemployed and out of the labor force, or hirings from the two groups, then that will show up as a measured change in the matching function, even though it may not be. And what we've had in the US is extended unemployment benefits. While extended unemployment benefits may reduce the effort and the willingness to accept jobs of some of the long-term unemployed, and so slightly interfere with the hiring process. When you get multiple applicants, getting one more applicant is not a big deal. But if what's happening to a large extent, and here I'm being speculative. There isn't data and there wasn't time to get further in doing my own research since October 11th. If what's going on is people are being measured as unemployed, they're on unemployment insurance, they report themselves as searching because you're supposed to get the benefits, but in fact they're behaving just like people out of the labor force, and without extended unemployment benefits they would be out of the labor force, then it looks like the hiring function is being inefficient because there are more unemployed measured unemployed relative to the pool of available workers. And something similar happens from the job perspective. There's lots of hiring that shows up in the data from the interviews with firms that happens without a vacancy. And there are two ways that happens. One is, since you're sampling, you come in with a date and you ask the question, who have you hired in the last month? Do you have any vacancies now? Then what happens if you post a vacancy, fill it quickly, and you're a firm that's not doing a lot of hiring, so you don't have a lot of ongoing vacancies, you measure the hire, you don't measure the vacancy. That obviously affects the interpretation of the data. Also, a great deal of hiring happens without posting a vacancy. Some of this is like the findings of sociologists that a lot of jobs are found by jobs being created. You know, my nephew's really a good kid. Couldn't you use another employee in your store? There's a great deal of that goes on, a great deal of word of mouth. That firm isn't really searching, but actually if somebody suitable came along would be happy to hire, and by word of mouth somebody learns of it and it gets filled without a vacancy. And historically we've had a lot of this where flows from particular rural areas to manufacturing jobs, people would just bring people in from the village they came from. The employer needs people, more people are brought in, common pattern. John Halterwanger told me his personal estimate is that 40% of hires are without vacancies, without measured vacancies, and that's made up of 20% that are filled too quickly to be measured, and 20% there is no vacancy. And Halterwanger, examining the data in detail, finds huge differences in the relationship between hiring and vacancies across industries, across firm size, across whether the firm is trying to add a lot of workers or only a few, or just doing replacement. So there is a big difference there. And for example, the construction industry tends to have very high rate of hiring relative to vacancies. A lot of this is short-term employment, education, health areas, very slow hiring relative to vacancies. In my department, if we're going to hire an assistant professor, we go through a process which takes a year. So there's a vacancy out there for a year, and with any luck we fill it. Sometimes they go somewhere else, life's like that, and then you have an unfilled vacancy for another year. So the processes are different, and what have we seen? We've seen a huge collapse in construction where hiring is efficient, and much smaller decline in hiring in education, and particularly in the health area, which is in the US a place with lots of jobs. So the lesson here is it may be the way a deep recession, different from a short recession, different from normal times, plays out differently, which means that there's nothing going on in the labor market that's unusual. We're just seeing the sub-pieces being combined into an aggregate that looks like a problem. And so the conclusion, I've got a few other examples, but I don't need any more to make this point. The point here is if you want to make inferences from the data, make sure you look at the details of what the data is coming from and what it's measuring. Early on, after the Lehman crisis, there was a working paper that came out of Minneapolis that says there's nothing unusual going on in the capital market. Bank lending is way up. is level. It hasn't collapsed. What happened when you dug into the data is firms that had lines of credit, who were afraid the lines of credit would not be renewed, they're set up for a finite time, were borrowing the money they had the line of credit to borrow, so that they'd have the money. What was collapsing was new loans. And of course, it's new loans that make a big difference in hiring. So by only looking at the aggregates, they were getting the story wrong. Dig into the details, both of the generation of the data and the aggregation issues that make it work. So I come away with the view, tentative view, because we haven't nailed down all these effects, that what we really need is a lot more aggregate demand stimulation in the US. The fiscal part has pretty much dried out, but the new agreement between the Obama administration and the Republicans in Congress will give us another fiscal boost. In the absence of fiscal boosts, the Fed has been doing everything it could on the monetary side, and I'm hoping this will help. And of course, any attempt to measure mismatch is going to be sensitive to the tightness of the labor market. The idea that you could measure that as something independent of tightness and then say what's left is cyclical seems to me to be basically wrong. Thank you.